aggressive, aggressive. And you're like, you know what? I'm tired of missing these trades. So what you start to do is scalp, smaller time frame retest. You're not waiting for a real rebalance. And all of a sudden you get this massive retracement on the higher time frames, and it really does eat up all your gains that you got on the way up. So big piece here is obviously if it's not going to retest, you do have to adjust. And so there are opportunities here to find smaller time frame ranges, smaller time frame lows and highs, and to trade those levels. As the market climbs higher, you have to reduce your risk. Well, you don't have to do anything. Personally, I'll be reducing my risk because the closer we get, the higher we climb, the closer we are to that big retracement. Now, this is a combination of two things. We have a Fed meeting coming up in about an hour, or in the decisions in about 30 minutes. The press conference will be in about an hour. We're going to get the Fed's decision here about more rate cuts. Now, to be honest, the economy is being stimulated. There's a ton of activity. The Fed does not need to cut rates, especially with all the hype now, with the Trump presidency and sort of this expectation of tax cuts for corporations, bringing jobs back, just a stimulation of GDP here. That's enough. Optimism is enough to get out of like a financial slump or a risk of a recession. You don't need to cut rates. But I think the Fed is going to cut rates regardless. And I think that's going to put inflation back on the table as a potential risk. If things are getting better and you're still pumping money or trying to stimulate, that's what Joe Biden did in 2022. That's why we got inflation up at 9%. Because they were still printing money through 2021, through a recovery that's already happened. And so what's going to happen here is the market is so excited about the prospect of a Trump presidency and this potential for a 25 basis point cut today that money is just finding its way to U.S. markets. So the way that global market investors look at where to put their money, it's all about risk. Okay, so the sentiment around the world is either risk on or risk off. So risk off means that you're likely to park your money in safe haven assets that don't move around in price too much. And then risk on sentiment is where you're willing to go further out into the risk curve and find opportunities that are riskier, but obviously come with a better reward. So when things are unstable around the world, when there's wars happening, typically you'll see a risk off sentiment. People will park their money in the US dollar, in treasuries and bonds, things that are very stable, safe, and don't have a lot of volatility. When there's risk on sentiment, it means the market is betting that in the next 6 months, the situation is going to be better than it is today. And because of that, they're willing to take their money off the sidelines and go put it in risky places, not expecting a big crash or a big, emergency happening. So they're foreseeing optimism over the next 6 months. So you have the prospect of a Trump presidency, prospect of this 25 basis point cut that we don't really need. And those are both extremely stimulatory. And so the rest of the world is starting to park their money in one of the riskier places in the U.S., which is U.S. equities, stocks. U.S. bonds, probably one of the safest assets in the world because you're loaning money to the government in dollars, and they have to pay you back in future dollars that they're going to print. We're one of the only countries in the world that can issue debt in our own currency, and that's it's kind of a cheat code that we have here. So you can either do government bonds, safe route, or you can go into stocks, riskier, way better return. And so you guys can see institutions that have been piling into the stock market, not just in this period here, but before the September consolidation. Okay, the institutions that were buying all the way through this, imagine what their portfolio looks like now. Everybody's 401k in the country is about to hit all-time highs if they're invested in the stock market. If your pension, your 401k, your Roth IRA, if anything is invested in U.S. equities, you're probably sitting at the highest balance you've ever seen. You're at all-time highs for your portfolio balance. Okay. So before I go through the Fed meeting predictions, first, drop a like and subscribe. Why? Because I ain't got to be fucking doing this. I hopped on here between my 75 different meetings to give you guys the real gems because I'm watching these news outlets lying to people about what the economy actually is doing. They're not looking at the data. They're all so obsessed over the Trump situation. They don't realize that the Fed controls more about economics than the president ever will. When you cut rates, okay, that is basically signaling to the capital markets, the money markets, to get their ass in gear, start moving money around. The president can only influence through sort of like through incentives and through executive orders. The Fed, if they cut rates, that is the only incentive that the money markets need to start flooding liquidity into the system. Okay, so before we do that, make sure to check out the link in our description. FX Summit 2024 in Dubai is 12 days away, people. I can't wait. Got an incredible speaker lineup. We have the top stock investors, top macroeconomic analysts, the top global macro investors, folks who have been on the New York Stock Exchange for 40 years, the longest standing stock exchange brokers, the top 5 crypto exchanges in the world, crypto.com, Binance, KuCoin, Kraken, and the rest. We have the biggest trading influencers in the entire space. Of course, we have Umar coming. We have Shabs. If you guys were at the summit before, Waqar Asim from the Titans of Tomorrow podcast. Love the podcast. He's going to be there. Calvin from the Forex Beginners podcast, Tory Trades, Noor Trades, Swaggy C, Dan Chung. These are folks you may have heard of before. Raja Banks, Wicks Don't Lie, if you guys have heard of him. The executive teams of the biggest prop firms for futures. We have the Apex Trader funding team, folks to come talk about algorithmic trading and the rest, Ali Trades. So many great speakers. We'll show you guys the full lineup as we get closer to the event. Use promo code Chartaddicts for 50% off all tickets. All right. And if you guys want to trade with Apex Trader funding, you guys can also use promo code Chartaddicts, one word, for 80% off your challenges. Please trade responsibly. Okay. So let's take a look at the Fed's decision. So if you guys remember back in September when the Federal Reserve had their most recent meeting, they ended up cutting 50 basis points. Now, the only reason the Fed would cut 50 basis points in an environment where we're not in a recession is if they see a recession coming. When you cut rates aggressively, it's because you see a recession coming, correct? Because why else would you want to stimulate the economy? If the Fed can keep rates at 5%, they would. But there's a lot of risks here. People keep asking me if the economy is stable and it's improving, is the Fed really stupid enough to continue to cut and send us into another inflation spiral? The answer is no. Obviously, the Fed's not stupid, right? Sometimes they're misguided. Sometimes they're too slow or too fast to act, but they have their eye on the ball. So what I think is happening is the high interest rates are putting pressure on investments that everybody holds. So I'm going to introduce you guys to a concept here called duration risk. Now, duration risk, there's all different kinds of risks with investing, right? There are market risks, which are things that are outside of your control. They're not, they don't have anything to do with your investment strategy. It's just the market itself is unstable. There's some geopolitical tension. So market risk is over there. Then you have portfolio risk, which is the risk that you overweight any one asset in your portfolio. And then in turn, it becomes too risky as part of your portfolio. And then duration risk is another one where the longer you hold an investment, the more likely it is that some BS will happen. Okay. Now, the duration risk with this high interest rate situation, and this is why Canada and Europe, this is why they're all starting to cut rates, because one of the biggest assets that everybody holds is bonds. And specifically, I'm going to talk about treasuries, but all bonds and debt. Okay. And so the biggest financial institutions like BlackRock, Fidelity, Schwab, Vanguard, State Street, what they are is they're basically asset management firms, asset managers that get the most amount of money is from pensions. So everybody, every 2 weeks when they take that money out your check, all that money ends up in one place. And that's going to be with BlackRock, Fidelity, Schwab, JP Morgan, whoever is doing your company's corporate plan, or if you have a private investment account, then it's, whichever company you're using. Anyways, so all that money is ending up in the stock markets all the time. It's ending up in the bond markets. Now, when you're holding bonds that have a variable interest rate or a variable return, that means they're subjected to the fluctuations in the Fed funds rate. So if I buy a bond and it has a 5% interest rate, just really fucking high, right? But that means that they are guaranteed to pay you 5% on your money. The government is, and they can print it if they need to. So if I have $1 million in government bonds, I'm making $50,000 a year for not doing anything. And there's no guarantees, but like if you can print the currency that's denominated in this transaction, then they're going to pay you back. Okay. And so as the interest rate fluctuates, if the interest rate is too high, then the service on this debt is way too expensive. Like the government is paying out way too much money. If they have to print it, they have to print way more than they expected. So reducing the interest rate reduces their obligations for these payments on the debt, and overall it just reduces the obligations of the government. So, anyways, major duration risk. This is what actually crashed Silicon Valley Bank, if you guys remember. Remember the bank crashes that, before the bank term funding program came out and they bailed them out. There was like 4 or 5 major venture capital banks and Silicon Valley banks that crashed. That was from duration risk. Interest rates started to go up. They were holding variable maturity bonds. And the thing is, when you're holding a trade, let's say like for these guys, it's an investment, but for us, let's say if you're holding a trade and drawdown, it's not a loss until you close the trade, right? So you can be floating in drawdown like equity, but it's not over till it reflects in your balance. And so a lot of institutions are holding trades, so to speak, in drawdown. And then all of a sudden word gets out and they try to pull their money out at the same time, and it ends up crashing the whole system. Sorry guys, I had a meeting here at 1:30. I want to see it got rescheduled. I'm gonna get to booth. All right. I just want to make sure my schedule is clear so I can trade through the Fed meeting. All right. So duration risk, those banks crashed. They got bailed out by the Treasury. Same thing's happening now. So some of the largest institutions are starting to feel the pressure. They're holding billions and billions and hundreds of billions of dollars collectively in assets and drawdown. This is called market. So when you like sit there and figure out, okay, what's the current price of this asset right now, market price? And when you mark your portfolio to market and you get an accurate read of if you're in drawdown or in profit on these assets, from a mark-to-market perspective, these guys are they're cooked. They are in serious drawdown. And then this is how bank runs happen, right? The risk of someone pulling their money out, or the risk of them not having your money, or the risk of them going out of business makes people panic and they start to pull their money out. Now, when you have to sell losing investments at a loss in order to service these withdrawals, that's when your bank goes out of business. All right, so they're trying to avoid that, which is the only logical explanation I have for why the Fed expects to cut 25 basis points in an environment where the optimism alone, like, look, when we were in the 08 financial crisis, the quantitative easing program and the TARP program that Obama put together with the Fed, Ben Bernanke, that did stimulate the economy dramatically. But, and I have to give credit to Obama for this, the Hope and Change campaign, the reason it took over the whole country, right, is because of that moment was almost like a Great Depression moment for us. And all it took was, honestly, before the QE, that money even started to filter through the system. The optimism alone got people out of this risk and out of this fear, and it started to stimulate more activity. The iPhone came out in 08. What's it called? I think it was like Netflix. All these companies came out in 2008. So there was this hope and kind of opportunity. It took, I want to say, about 4 to 5 years to climb our way out of that, but it was already in motion. And so I think the same thing is happening now. The optimism alone of the Trump tax cuts, of potentially cutting the government budget with this agency that Elon Musk is going to head, this sort of optimism and strength, and people sort of taking their money out of Europe, which has been very disastrous for investments, taking their money out of Asia, which has only become riskier and riskier, and then slowly getting that money back to the United States. So we don't need rate cuts. Just the optimism alone could get us where we need to go. They're cutting rates anyways. So either they're dumb, they see a recession looming, which, if there is a recession looming, we'll be fine. Or the number one most likely scenario is all these banks, all these asset managers, and the government itself is feeling the pressure of the high interest rates and the high burden of having to service this debt, and they're trying to turn back the clock. Okay, so that's my Fed meeting predictions. 25 basis point cuts. We'll be back at 2:30 p.m. and then we'll go and kind of figure out where the markets are at the time. What do you think will happen with the price of crypto after today's meeting? Okay, so let's actually go through predictions for the meeting and price. No, crypto. Who here remembers when I've been saying that the bull run would start in November? Does anybody remember this? When we had the halving back in April, and we had that prediction for the Bitcoin halving. Let me see if I can find this. Let me see if I can find the BTC predictions here. Okay. I'm gonna find this. Just give me 1 second. This is important. This is very important. So we ended up doing a live event in Puerto Rico, and I spent about an hour at that live event, basically letting everybody know that the November timeline was what I was expecting. For here it is. Nice. Okay. So this was the Bitcoin halving. Okay, we were expecting price to make it down to, what is this? About 50,000, right? That line right there that says that's about a little bit under 50K. Would you guys agree? About 49,000? Let's see what Bitcoin actually did. Interesting. Yo, what does that price say right there? Let me delete this. That's so close, right? That was 49,000. It made it to 49,650. And then now we're ripping all the way back up. So the prediction, and I think we even had a prediction even better than this. There it was. Yo, did we call the exact price at the Bitcoin halving? Like, look at this prediction here. No, because we're gonna really have to go through this. Look at this. So the prediction for the Bitcoin halving was 60,860. Okay, 60,000. You guys see that shit? You can't even make this up. Then I wanted a rebound for a double top. Okay, and you guys can look at the date here. The date is somewhere. The date is somewhere. You guys can look at the date for that current price. Yeah, you guys can find the date to see that this was done live. This was on YouTube. You can find the recording on 4/12. This was back in April. This prediction was made. So hit off 60,500 double top, come back down to that 49,000 area, and then rebound all the way back up. What happened? We hit the 60,500, rebounded for the double top, broke down, missed it by about $500, and then guess what? That November timeline for the all-time highs. All right, can I get something in the fucking chat? This, guys, how long ago was April? That was 7 months ago. 7 months ago. 7 months. All right. Before, like, even the exact price of where it was going to be on the Bitcoin halving, get the fuck out of here. No, I'll zoom in for you if you guys don't believe me. Y'all see that shit? Come on, bro. All right. Anyways, so yeah, that's crazy. Um, and we even went through the whole analysis for this thing. If you guys paid attention, we went through every single Bitcoin halving and talked about how long it usually takes. Okay, use our predictive analysis to basically find out a timeline. And I said, load up. I didn't say load up, not financial advice, but whatever you have by November is going to be your holdings while when it starts to move. This is the presentation I did in Puerto Rico for that live workshop, and I just basically went through the first halving. If you started with 12, the starting price was $12. In a year, it was at 1,100. Your return was 9,400%. So if you invested $100 in 2012, you'd have had $9,400 in 2013, a year later. The second halving, if you put $100 in, a year later, it'd be worth 3,200, which means if you put $1,000 in, it'd be worth 32,000. If you put 100K in, it would be 32 million. Am I bugging? No, 3.2 million. Okay. So if you invest $100 in 2020 during not the most recent halving, the one right before, it'd be worth about 650. Okay, because the starting price was 9,000. In a year, it was at 60,000. Big gains. And then over here, if you invest $100 in 2024, it would only be worth about $200 in 2025. Because really, realistically, like from 70,000, even if we make it all the way up to 140K, that's only a 2x move. You understand? So it's not about like just buying these meme coins. Bitcoin is different because it's all about owning Bitcoin. Regardless of how you do it, you want to get in at the best price. So I use meme coins, grow those, and then basically convert over when the meme coin is stronger than the Bitcoin price, so I get more Bitcoins. But everything else, you want to buy at a discount when it's on the floor. That's why right now the hype train is kind of convincing everyone that Bitcoin's going to keep going and this is it. And so as soon as I start getting my friends who don't invest or trade asking me about Bitcoin, that's when I know the top is close. Make sense? The top is close. People who have been holding Bitcoin for a year and a half, 2 years, Bitcoin's been dry. They're sitting on a shit ton of money right now. They're sitting on a lot of profits, and they're going to be looking to take some profits off the table here soon. All right. And when that happens, we're going to ideally and hopefully see a big retracement. And that way we can get back in at a good price. Okay. Will I be buying Bitcoin at these prices? Hell no. I'll be buying altcoins. I'll be buying meme coins. I'll be buying things that have a higher multiple return. Okay. Because I want to go for 20, 30, 40x opportunities and then convert that money over to Bitcoin instead of, using my liquid money to buy Bitcoin straight up. Okay. Ladies and gents, I have to hop off. I'll come back at 2:30 for the press conference. What I'm seeing for Nasdaq here is we're very likely to get a retracement around the Fed meeting, but we're probably not going to retrace this entire move and come back down to the London or the New York lows. Okay. I'm here on the smaller time frames called the 1 hour. Here's the most recent area of structure. We had this massive expansion. In a perfect world, we get a full retracement of this move before we continue. But because of how aggressive the market is, we might really just, if you guys see, might have to get down to the smaller time frames here for this one, but you'll see this area here. Members, before we hop off in the Zoom chat, what is this area called? What am I looking at here? For everyone else on YouTube, this is an area of structure that is very relevant. Okay, so you have this area right here, no traffic, big expansion. Then you have this area here. So consolidation, expansion, little gas. We kind of picked up some gas right here, a little pit stop. And then now we're sort of doing this 1, 2, 3 drive pattern. So members, you guys know what the 3 drive pattern indicates. And so I'm looking for, you can either see a correction of this. It'll probably wick through just a little bit and then continue. Or if it's a perfect world, the market retraces all the way back down to the New York lows. And we can take a trade at a discount here. And just the market's just going to keep ripping. Wake up and buy. Awesome stuff. All right, y'all. I got to hop off for these meetings. Happy and safe trading, people. Keep crushing it. And yeah, think less, do more. Doubt less, do more. If you're busy, you don't have time to doubt yourself. And if you're busy, you're going to get a bunch of shit done, right? Crush it. Drop a like and subscribe. And of course, make sure to check out the FX Summit 2024 conference. Grab your tickets using promo code Chartaddicts, 50% off. Come see us out there. And if you want to, if you're a forex related business, if you have a group chat, if you have a big forex influence, reach out to us ASAP. info@chartaddictsfx.com. If you know anyone, if there's a big trader that you guys want to see at the summit, if there's anybody in the space that you guys want to see at the FX Summit, let us know who they are. info@chartaddictsfx.com. We'll see you guys out there. Happy and safe trading. Peace.